From the morning reading, the selling continues in advance of the FOMC meeting. The S&P 500 logged its third consecutive daily loss, a 0.81% decline, fractionally off its minus 0.84% intraday low shortly before the close. The popular financial press offers two explanations for the selling. One, a message to the FOMC in advance of its two-day meeting that starts tomorrow, and two, anxiety in advance of the Brexit vote 10 days from today. A 10-year note closed at 1.62%, down 2 basis points from the previous close and only 19 basis points above its record closing low set in July of 2012. The 20-year bond yield at 2.01% is at a post-recession low, and the 30-year bond is only 18 basis points above its post-recession low. The S&P has been flirting with a high, but few sectors are leading it. Only one sector out of 10, utilities, has reached an all-time high in the past month, despite the S&P coming to within 1% of its own high. That's an abnormally low participation rate among sectors, which has led to inconsistent weakness in stocks. Uncertainty has jumped even with a small decline in stocks. Whether it is fear about the Fed, Brexit, or other known unknowns, the rise of the VIX over the past week is nearly unprecedented with such a small decline in the S&P 500. Using a proxy VIX back to 1962, similar situations didn't lead to anything consistent. The green extremes of the Optex heat map are dominated by country funds. Spain, EWP, and Italy, EWI, are showing the most pessimism, both with optimism indices below 10. But with the funds in a defined downtrend and their moving averages still not showing any extreme, they are not good candidates to look for mean reversion bounces. If optimism drops below 5, that is a good sign for the very short term, but anything other than longer than that is usually preceded by a 10-day average declining below 25 at least. The SPM, IWM, the Qs continue their pullback. The VIX spikes. Retail sales on Tuesday, FOMC announcement on Wednesday, Microsoft to buy LinkedIn in the largest deal in Microsoft's history. All 9 sectors moved lower on Monday. XLU, XLE, and XLY were the strongest sectors, while XLK was the weakest sector. All futures fell 32 cents to close at 48.56. Breadth strengthened. Actually, that should be breadth weakened as decliners led 22.96 to 7.36 on the New York Stock Exchange and 19.33 to 6.65 on the NASDAQ. The spiders sold off in the last 75 minutes of trading, and the VIX spiked to its first close over 20 since February 29th. Spider momentum slowed on Monday and breadth strengthened compared with Friday. Spiders, IWMQs, and diamonds are still forming potential bull flag patterns. We continue to wait for the pullback to complete and bounce before taking a bullish trade. The VIX spike is interesting in the light of the May retail sales report coming Tuesday before the open and the FOMC announcement on Wednesday. The spiders has fallen 1.92% over the past 3 trading days since its high on June the 8th. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 5:42 a.m. Mountain Time, and I'm recording this in preparation for the market day of June the 14th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Let's go ahead and dive into the morning report. And indeed, a bit of weakness, pretty universal. All 4 broad market U.S. indices are down at about 0.25% at the time of this cut. Crude oil down much more sharply at about 1.35%. Euro down about 0.6%. U.S. bonds are up about 0.5%. and the gold is down just below scratch. China up after a big down day yesterday. It's up about 0.32%. Hong Kong is down about 2/3%. Japan continues its fall, and it's down about 1%. Germany continued weakness, down nearly 1%. United Kingdom down over 1%. In terms of the macroeconomic reports of note for today in the United States, as one of the morning authors mentioned, we do have the retail sales and import prices. And looking forward to tomorrow, a much larger list. And with respect to the U.S., you have PPI, Empire State Manufacturing, Capacity Utilization Rate, Industrial Production, the weekly crude oil inventories, and then, of course, the FOMC announcement with its statement, its Fed funds rate, and economic projections, along with the press conference. So big day with respect to the FOMC. So heating up in terms of the macroeconomic reports and their impact, both today and tomorrow. Pretty significant jump and the ability to influence the market in a big way compared to what we had yesterday. In terms of current volatility conditions, let's see here. Look at this short-term VIX all the way up to almost 23. Skew, let's see here. Skew's actually 137 and change. So this continues to climb, and now that it's up over 135, that is a significant warning. So keep that in mind. IV percentiles have also climbed. These were down in single digits just a few trading sessions ago. You have the SPX at a 33 now, the Russell at a 35, the NASDAQ at a 22, and the Dow at a 28. Now, let's keep these in perspective. You know, that's still below the 50% middle of the percentiles. So they're still relatively low, but coming from where they have, as fast as they have to get to these numbers, you know, this is a big change from what we've been at of late. Also, if noticed, we've had back-to-back trading sessions with more than one standard deviation moves in 3 of the 4 indices. The NASDAQ, I know, has had 2 distribution days in the past 2 sessions. So this is a pretty steep increase in volatility after having a very, very prolonged session of days where there was nothing to speak about in terms of standard deviation moves on a close-to-close basis. Let's go ahead and go to the charts. And let's go ahead and start with bonds since we're already there. And that's perhaps some of the most interesting things going on. Look at TLT, the ETF for the long bond, a record high close, 135.39. In the trading room, we have a pretty significant position in TLT with respect to our ETF rotation strategy, one of the core portfolio strategies that we model. We model several, and this is pretty much a parabolic move. You heard several references from the morning author reading about near record yields and so forth, and obviously as yields go down, the value of the bond goes up, and you're seeing this reflected here. And it's probably too late to get in and take a new position. This is getting into pretty heady area. And indeed, the question starts to become, if the market actually does deteriorate and break down, you know, how much further will this run? You don't want to cap off your profits just when a head of steam is getting going, but you may also need to continue to watch this chart very, very carefully and watch for signs of reversal, because once you get a parabolic move, they almost always end in an ugly way and give back a big significant chunk of that move. And we could take a look just in our own chart here. You know, you see this huge move here in February as you had the weakness in the broad markets, and of course bonds is the safe haven status, is going to go, and it went from, 119 and change all the way up to 135 and change, and it did that in about a few weeks here. I guess 1, 2, 3, 4, maybe about 5 weeks roughly, without counting. And so big moves related to that safe haven status. Well, when you get that steep an angle, it often gives back quickly. And you see here in 2 trading sessions, you would have come back from the 135 handle all the way down to 128 and change. So these things can really come back quickly. So you have to kind of watch for those reversal patterns. And depending on your time frame, consider whether you need to bank some profits or protect those profits with perhaps the purchase of puts and those kinds of things. There's a number of different ways you can do this, but this is pretty much a parabolic move, and we're coming into those record numbers. Let's go ahead and look at the futures on bonds and see if that tells us anything different. Clear breakout. We've been talking about that. Very, very strong, and you see the overnight pattern here right now. This would seem to be continuing right now with our overnight action down off the highs and our Globex high, but still a very strong bullish pattern continuing into the open today at this time. And we've got about an hour and a half until the market, broad market, opens and all the cash participants begin to participate. In terms of our S&P futures, bit of a continuation thus far, and we're starting to come into about let's go ahead and look at the SPX. And we're about to come in. Of course, the SPX hasn't opened yet, but I would suspect that we're coming into about the 50% retracement. If you were to project the futures onto the SPX, we're probably coming in close to the 50% fib retracement. So we're coming into that sweet spot. Many times you'll see a box drawn between the 50% retracement and the 618 fib retracement, as where pullback entries are made by traders. And looking for this to be a sweet area, and it's an area, it's not a specific price, in which to take anticipatory entries when you get these pullbacks in a bullish trend. So we're probably getting really, really close to that. So one of the things that might tell you is to start watching for retracement patterns coming to an end, watching for those reversal patterns, coming into key areas of support. Certainly one of the tools that we use in the trading room is the daily price guides that I publish each day, and this will identify all the most likely classic support and resistance areas. And it's a very, very handy intraday timing tool. And whether you're a day trader or you're a longer term trader, having those more exact areas to pick as your areas of support and resistance to be able to initiate even longer term trades is very, very helpful. But this is kind of coming into an area of interest, and we're going to start to get our radar going and watching for those potential signs. So this pullback could start to come to a bit of an end if indeed the bulls are going to resume their activity. Now, that being said, we've got a lot of macroeconomic reports today, including those retail reports, and retail has been just getting hammered of late. So we'll watch that. That could obviously give some energy and momentum to whatever direction they point to about the economy. And then, of course, you're setting up with tomorrow. We could very easily go into a bit of a sideways consolidation pattern, flat, going into the action of the FOMC reports. So between today and tomorrow, could start to see this pattern stall out, waiting for the FOMC, and then once we have the FOMC information, a new inflection point, energy or momentum to take off from that. So those are some of the potentials that are lining up out there and what might happen in the next couple trading sessions. In terms of the Dow Futures, very similar pattern on the Dow. Been very, very high correlation between the Dow and the S&P of late, and that hasn't changed. NASDAQ, of course, has had back-to-back distribution days, relatively weak. Now, of course, a big part of this is probably related to Microsoft. I presume that Microsoft is also part of the NASDAQ as one of the classic tech companies. I'm not positive about that. Sometimes these compositions can surprise you. But anyhow, bottom line is that part of this decline in distribution might be related to the NASDAQ's participation of Microsoft and its acquisition of LinkedIn. LinkedIn, that by some 20-something billion dollars, is the largest acquisition in the entire history of Microsoft. So it's a very, very big deal. And of course, as a result of that announcement, Microsoft goes down. You got to keep in mind, anytime you hear a big acquisition, the presumption is that the company that's doing the buying is probably paying too much, and as a result, their stock goes down. And then, of course, the stock that's being acquired, they're getting a premium on their price. And certainly, it sounded like from what I read about the LinkedIn deal that they're getting a very hefty premium in which to sell, so they go up, and that's kind of what happens. Now, oftentimes that's a short term. Obviously, the management at Microsoft thinks that there's a strategic opportunity in acquiring this LinkedIn deal, and that in the long haul that this will be very, very good for the company. And you often see that reflected in the price action going forward, that while you may have the initial pullback due to the, in quotes, overpayment, that in time that bounces back. So we'll see. We'll watch that chart. Microsoft is one that we trade regularly in the trade room. And then, of course, the Russell. The Russell also in a pretty stiff pullback, though coming into some pretty important key areas of support. Let's see, crude oil. Crude oil, of course, has been in a very, very high correlation. I think I saw something about a 92% correlation with the S&P in this move up off the February lows. And it also is in a retracement, though, just simply coming into the kind of the lower part of the trading channel that it's been in of late. So yet, nothing scary here, just a pullback. Now, question is, when does the pullback become something bigger and go into kind of the correction territory? Well, we'll talk more about that in just a second as we go to the daily report. But at this point, most of the signs are still saying that this is just, a mild pullback and a bullish trend, especially the short to intermediate term trend. Now, gold, of course, also safe haven status. You see the overnight in this last candle, not happening very much, but certainly big move in the last couple trading sessions and last couple trading weeks, bringing us all the way back from the swing low to nearly back to the swing high that occurred in late April. So bonds and gold, safe haven status areas, both making very, very large corresponding moves. Let's go ahead and go to the daily report. The daily report has some significant changes coming into play for today. First of all, intermediate term phase opinion. We've had a break of the diagonal and horizontal support lines in our S&P chart, and as a result of that, our phase opinion has changed to what's called in shorthand the end short term. So this is a important breakdown in our signals and a sign of deterioration. So we're going to start to pay more attention to the potential that this is going to develop into something larger than just a pullback. Now, it doesn't say definitive yet that that's going to happen by any measure, but we're starting to get some of the warning signs that tell us that that could very much be a potential. The second really big sign are market timing signals. These are three different mechanical signals. The first one coming from IBD and it has gone into the first level of warning. It's now gone to uptrend under pressure. So another shot across the bow with a significant warning. And the second mechanical signal, there's no change here, but there's a big asterisk in that this author took the day off. He announced he was going to, so there was no update to this information from the Friday session. He did publish over the weekend, but not last night. So while this may have actually changed and deteriorated, we don't know what that is at this point. So just something to kind of keep in mind. But I suspect that this probably came down a notch or two with yesterday's follow-through action. And then in the third mechanical signal, the stock charts decision point scoreboard, no changes here as of yet. So we still have the primary signals coming across the different indices in the short and intermediate term are all still universally bullish. So this isn't like everything's just all of a sudden started falling, but we have had a couple signals start to change, and the tide, as it were, has started to reflect this weakness on these mechanical signals. As a result of these changes, the two position sizing opinions have started to deteriorate. We've had, from the portfolio investor position sizing opinion, this has now dropped to a 50%. And from the volatility for the active trader, this has also dropped to 50% with this big spike in the VIX. In terms of the intermediate term market posture, it is still severely strong bull on 3 of the 4 indices, but note, they're just borderline. If this drops below an 80 with any continued weakness today, this will go to weak bear. And you see the Dow had been the weakest of the 4. It took a long time to even get to the severely strong bull category, and it's the first to turn to weak bear. A bit interesting in that most of the time you think of the Dow as those more defensive, dividend-bearing kind of holdings, and where people, if they're fearful, often, are buying. So, and if the market truly is fearful, that you would expect this to actually potentially be the stronger compared to the NASDAQ and the Russell in particular. So this has been a bit of a divergence if you are bearish on the broad markets. If you are super bullish on the markets, then this makes a lot of sense, because money would rotate out of these kind of tired old dividend stocks into areas where there is more growth potential. So we'll have to see how this plays out, but there's a couple things of interest here. First being that this deterioration now borderline, and we could start to see a lot of this turn red in another session or two if these numbers continue to drop. In terms of the hedge warning status, I really thought about whether this needed to go to a level 1+, but I think the fact that I retained level 1 in recent trading sessions is still adequate to reflect the level of hedge risk that is in the current market. We had anticipated, as a result of the intermarket risk aversion indicators all rolling risk off, several trading sessions ago, and those gave us a very good heads up that things were perhaps starting to become a bit more shaky for the bulls, and then we might see something of a pullback, and indeed we got that. Along with that, we kept up with this level 1, and we never really dropped to the 0+, the more normal levels, and I think that we're smack on where the risk opinion should be at this time. In terms of strategy opinions, you notice that we've had a significant change here. Option income strategies, the VIX is now in the not acceptable window to initiate new positions for novice traders. Now, more aggressive traders who are prepared to handle the adjustments and the larger than expected moves with Delta and Vega that comes with these higher VIX levels may find some opportunity, because certainly you're going to get more premium with these higher VIX levels. But at the same time, you're dealing with inflection points such as the FOMC announcement and the like that may cause you to have to make a lot more adjustments than you will have when the VIX is in a lower window. In terms of cover call strategies and put selling, not any new opinions quite yet. Still relatively bullish, still 3-to-2 ratio in both the strike selection of in the money, out of the money, and in the low beta, high beta. But given that we're kind of borderline acceptable, that is the change in both of these opinions from yesterday, you might want to, if you do initiate any new position, consider legging in through the use of put selling spreads, or you might want to make sure that you're using more low beta, more in the money and out of the money versus out of the money. You might want to start shaping this a bit more defensive than you would. I'm not likely to initiate a new cover call strategy today in the face of the upcoming FOMC and the current conditions. So, I certainly in my own trading am becoming a bit more defensive in terms of my initiation here. As we go down to the specific warnings, look at this. This is pretty much a universal sea of red here. Just about everything that can be read under the volatility-based area is red. I mean, this one only turns red if volatility is exceptionally low and you're anticipating an increase. NASDAQ distribution day count had fallen below a 5, which is the warning status. If one more distribution day, that goes back to warning status. But really, that's the only volatility-based metric indicator that is not flagging in a warning status at this time. We have the market in decline, the sharp increase warning. That's 2 sessions now. The ratio warning is absolutely fired in the cleanest setup of that ratio firing that we've had in quite some time. We had with yesterday's jump in the volatility a spike fire off. VIX futures also went well up over 18. We have the daily squeeze has fired now. So we're now 2 sessions in to where the squeeze has fired. So that is also calling for an expansion of volatility. VIX phase has been increasing, and we now actually have the skew up over 135, and it's probably more like a 12% probability of a 2 standard deviation move in the next 30 days. And then, of course, on the last one, the 10-day expected move on the SPX is easily up over 40 now. That had been, even into the high 20s not too many sessions ago. So that is definitely spiked up. In terms of our trend base, we've had this change into the intermarket phase opinion. And also look at the new high, new low. Technically at 300 is where I put this into warning status, but obviously this is so close. Went ahead and flagged this, and then we saw and credited the intermarket risk aversion indicators. All 5 of those basically called this move several sessions ago. So this has been a very, very good indicator of late. In terms of sentiment, some of the excessive sentiment has ebbed off. You see short term, only a 4, though bonds are kind of extreme. We talked about the parabolic move that bonds have put in of late. Fear and greed index almost down to a flat out neutral, just above the midpoint. China also pretty high sentiment, so watch for reversal patterns. And then finally, let's look at the sector percent change. A lot more red starting to show up here in the short to intermediate term. Again, focus on what's holding up: consumer staples and utilities. And in fact, another one of our core portfolio strategies in which we use dividend aristocrats, we made a couple rotations yesterday. And in those rotations, there was a consumer staple and a utility company that was added to that portfolio at the expense of 2 other holdings. So you could see how these things kind of line up and how they influence, what happens with the decisions of the portfolio management. In terms of percent change, even utilities, even the telecom, and the consumer staples, they were all negative yesterday. Everything was negative. When the market gets really, really weak, even the more defensive sectors are negative, though the tendency is that they will hold up better. So we'll continue to see where this pullback to potentially something bigger now starts to develop. I suspect that the FOMC will have an awful lot to do with what the outcome of that answer really is. So we've gone very long today. Very, very important day. A lot of warnings coming into place, and we wanted to understand what that means to our trading. So let's go ahead and just roll through the closing sequence. If you see something that you have of interest, just hit the pause button, hit the hyperlink, get the additional details. Disclaimers as always, we needed to get to this, and if you need more time with the disclaimers, just hit the pause button here. Do note the hyperlink down here at the bottom for the full set of disclosures. We'll see you back here tomorrow for tomorrow's market preview from Falcon Global. In the meantime, good trading to all.